For years, the advice seemed unquestionable. If you wanted a safe, long-term strategy to grow your wealth, just buy an S&P 500 index fund and hold. This idea was so widely accepted that even Warren Buffett, the most legendary investor of our time, made it a cornerstone of his public recommendation to most investors. He often repeated, "Don't bet against America." And what better way to express that optimism than by owning a piece of the 500 strongest companies in the U.S.? But something unexpected just happened. Warren Buffett, yes, the same man who publicly advocated buying low-cost index funds like SPY or VOO, has now sold out his positions in those very funds. And that's raising eyebrows across the financial world. Could be that the very symbol of simplicity and safety in investing, the index fund, is no longer as safe as we thought. This isn't just one investor making a minor move. This is Buffett, the man whose portfolio decisions are studied like scripture, the man who tells his heirs to buy index funds when he's gone. So if he's pulling out of them, even in small amounts, it forces a bigger question. Are index funds still the smart move in today's market? Let's unpack the paradox. Index funds were designed as an answer to complexity. Instead of studying balance sheets, analyzing risk, forecasting earnings, or identifying undervalued gems, you could just buy the entire market. That's the promise. Diversification without the stress. And for a long time, it worked brilliantly. Historically, the S&P 500 has delivered annual returns above 10% since 1957, outperforming bonds, international stocks, and even real estate. Investors who held through the decades saw their wealth multiply, all while doing virtually nothing. No complicated strategies, no constant rebalancing, just consistency. But here's where things start to shift. Today, more money than ever is flowing into index funds. Trillions of dollars, in fact. And when too much money chases the same group of assets, prices get distorted. The S&P 500 is no longer just a diversified representation of American business. It's increasingly a concentrated bet on a handful of tech giants. Look at the numbers. Apple, Microsoft, Amazon, Meta, NVIDIA. Just 5 companies now account for nearly 25% of the entire index. If you invest in the S&P 500, a quarter of your money is going into 5 companies, whether you like it or not. This is no longer diversification. This is exposure masquerading as safety. And here's another problem: valuation. These tech behemoths are trading at price-to-earnings PE ratios in the 30s, even 40s. Historically, the average PE ratio of the S&P 500 is around 15. That means you're now paying twice as much for the same dollar of earnings. And in investing, price matters. The more you pay for earnings today, the lower your return will be tomorrow. Imagine this. If a company generates $10 in profit per share and you pay $20 for it, you're getting a 50% earnings yield. If you pay $200 for the same $10 in profit, your yield drops to 5%. The higher the price, the lower the expected return. That's basic math, and Buffett knows it. So maybe it's not surprising that Buffett has been increasing his cash reserves. When assets feel overpriced, the best move isn't to chase returns. It's to wait. This brings us back to the question: is the index fund still the best way to build wealth? For a long time, yes, but markets evolve. Circumstances change. And when nearly half of the S&P 500's movement depends on the performance of just 10 companies, we're no longer talking about a safe, broad investment. We're talking about concentration risk, the very thing index funds were supposed to protect us from. To make matters more interesting, other legendary investors are voicing concern. Michael Burry, the man made famous by The Big Short, has compared today's index fund craze to the subprime mortgage crisis of 2008. He argues that passive investing has removed real price discovery from the market. Investors pour money into funds without analyzing the actual businesses underneath. It's blind buying, and that always comes with a price. Warren Buffett's move may have been small, a sale worth just 0.01% of Berkshire's massive portfolio. But in investing, even small signs from giants matter, especially when other investors under the Berkshire umbrella, like Ted Weschler or Todd Combs, are likely the ones behind the transaction. But here's the twist. Even if index funds are still technically a sound idea, they may no longer offer the returns people expect. With the S&P 500's current PE ratio hovering near 28, almost double its historical average, many analysts predict returns will range at just 3% to 5% annually over the next decade. That's not terrible, but it's not exciting either. And here's the part few people talk about. What if that 3% turns out to be optimistic? Buffett has hinted that even expecting 5% might be a stretch in the current environment. And he's not alone. Many professionals quietly agree. But the retail investor, still told to just keep buying the index, doesn't realize that the returns of the past may not resemble the future. So what do? That's the question. Some investors are beginning to look elsewhere, to undervalued international stocks, alternative asset classes, or even actively managed portfolios. The reality is this: index funds aren't bad. They're just not the sure thing they used to be. Not at these prices. Not with this level of concentration. And not with this much blind capital chasing a handful of overhyped stocks. That's why it's important to step back and reassess. Don't just follow advice that worked 10 years ago. Understand the current market environment. Question the assumptions. Because even Buffett, the man who once said, "My money is going in an index fund," seems to be stepping a little more cautiously these days. Now I want to know, if you invest in index funds, does this change your perspective? Share your thoughts below. Hit the like button if this gave you something to think about, and pass it along to someone who still believes index funds are always the safest bet. They might thank you later. It's easy to forget how fragile a system can become when everyone believes it's unbreakable. The S&P 500 index fund has long been championed as the most reliable way to build wealth. It's low-cost, diversified, and time-tested. But when Warren Buffett sells, even a small stake, and when voices like Michael Burry begin drawing comparisons to the 2008 subprime crisis, the message is clear. Something in the foundation is shifting. To understand the risk, we need to go beyond the headlines. Let's talk about how index funds actually work. When you invest in an S&P 500 fund, you're not just spreading your money equally across 500 companies. You're investing based on market capitalization, meaning the bigger the company, the bigger its share in the fund. And that's where the first crack appears. Over the last decade, we've seen massive capital inflows into index funds. Billions, even trillions, of dollars pour into these passive vehicles every year. But what happens when everyone buys the same thing? Prices get inflated, not because of improving business fundamentals, but because of sheer demand. This distortion isn't theory. It's reality. In the 1990s, the top 10 companies in the S&P 500 made up about 18% of the index. Today, that number has exploded to over 40%. In other words, nearly half of your diversified investment is sitting in just a handful of names. Companies like Apple, Microsoft, Nvidia, Amazon, Meta, Alphabet, and Tesla. So, while the package says 500 companies, what you're really getting is exposure to 10, and at extremely high valuations. Let's break that down with real numbers. Apple currently trades at a price-to-earnings PE ratio of 35. That means if Apple's profits stay flat, it would take 35 years to earn back the money you paid for the stock. Microsoft's ratio is over 30. Nvidia, one of the hottest stocks of the past 2 years, is pushing a P ratio of 37. These are lofty numbers, especially for mature companies that have already seen massive growth. Now let's ask a question no one wants to ask. Do these prices make sense? To justify a $3.5 trillion valuation like Nvidia's, the company would need to generate hundreds of billions in cash flows every year for the foreseeable future. But even optimistic projections strain under that kind of pressure. Investors are pricing in perfection, and markets don't deliver perfection for long. This is why legendary investors like Buffett and Munger have always said the price you pay determines the return you get. And when prices are this high, expectations have to come down. Many analysts, including those close to Buffett's circle, are now projecting 3% or lower as the realistic return from the S&P 500 over the next decade. It gets worse. Because of how index funds work, the more stock goes up, the more it gets bought. This feedback loop leads to dangerous concentration. When everyone is blindly putting money into the same few stocks, price discovery, the process of accurately valuing a business based on its fundamentals, disappears. That's exactly what Michael Burry warned about. He called index funds today's version of the synthetic CDOs that fueled the housing crisis in 2008. Back then, risky mortgages were bundled into financial products that no one really understood. Ratings agencies stamped them safe, and investors bought in without asking questions. When reality hit, the system collapsed. Index funds, Burry argues, are following the same script. People are pouring money into them without understanding what they own. They don't know the valuations. They don't understand the debt levels or profit margins. They just trust a model, buy the market, and you'll be fine. But when a system depends on everyone believing in it without question, it becomes brittle. And when the flows reverse, when investors start pulling money out, it can get ugly fast. And let's be honest, we've never seen this kind of passive dominance before. Today, over 95% of trading is done by passive vehicles, quant funds, or algorithms. Only a sliver is done by humans analyzing real businesses. That's not healthy. Worse yet, many investors aren't even choosing the strategy. It's automated. When you get a new job, you're automatically enrolled in a retirement plan. Your money gets funneled into an S&P 500 index fund without a second thought. Most people don't even realize where their money is going. They just assume it's smart because it worked in the past. But markets don't reward assumptions. They reward understanding. Chamath Palihapitiya, a controversial but sharp voice in tech investing, recently called out another danger. He pointed out that the S&P 500 is being marketed as a basket of 500 companies, but in reality, it's 10 companies doing most of the lifting. That level of concentration means your investment isn't nearly as spread out as you think. If one of those top companies stumbles, the entire index feels it. And if several do, the fallout could be massive. So where does this leave us? Are index funds bad? Not necessarily. But they're not immune to risk. And they're certainly not guaranteed to deliver the same results they have in the past. If you're putting money into index funds today, hoping for 10% annual returns like in previous decades, you may be setting yourself up for disappointment. At current valuations, many experts would consider 3% to 5% annually a generous assumption. That's not a disaster, but it changes the equation. Maybe that's why Warren Buffett's team sold their index fund positions. Yes, it was a small sale. And yes, it might have been made by one of his lieutenants, not Buffett himself. But when even Berkshire Hathaway is trimming exposure, it's worth paying attention. The sale included 39,000 shares of SPY and 43,000 shares of VOO, roughly $45 million total. That's pocket change for Berkshire, whose portfolio exceeds $267 billion. But still, it was a full exit, not a trim, not a reallocation. A complete sell-off of S&P 500 index exposure. And that means something, because if the world's most respected investors are choosing cash over index funds, even just slightly, you have to wonder what they see coming. So let me ask you this. Knowing what you now know, would you still keep putting your money into index funds without asking questions? Let's talk about it in the comments. I want to hear your perspective. If this changed how you think about your investments, go ahead and share it with someone who needs to hear this today. Let's face it, index funds have earned their reputation. Since 1957, the S&P 500 has delivered average annual returns of over 10%, outperforming almost every other mainstream asset class. That performance made millionaires out of patient investors. It made the buy and hold strategy more than just a cliche. It made it a proven path to wealth. But here's the uncomfortable truth. Past performance does not guarantee future results. And when the financial landscape changes, so should your expectations. Right now, we're looking at an index that is no longer just diversified exposure to America's best companies. It's a heavily concentrated bet on a handful of tech giants. Apple alone makes up over 7% of the S&P 500. Microsoft follows closely at 5.8%. Then come Nvidia, Amazon, and Meta, each with P/E ratios soaring in the 30s or more. Think about what that means. If you invest $10,000 in the index today, Nearly half of it goes to 10 companies. You're no longer buying the market. You're buying most expensive stocks in the market at record valuations with very real questions about future growth. These aren't early-stage disruptors. These are mature giants. Their best years of explosive growth may already be behind them, and yet investors are still paying prices that reflect perfection, as if the next decade will look like the last. But here's what few people say out loud. It probably won't. Warren Buffett understands this. So does Michael Burry. So do a growing number of hedge fund managers, analysts, and institutional investors. That's why we're seeing cautious moves, increased cash positions, and quiet exits from positions like SPY and VOO. The message isn't that index funds are bad. It's that their current structure and valuation make them far less compelling than they used to be. Let's zoom out and look at the broader investment landscape. From 1985 to 2024, cash returned almost nothing. Bonds underperformed inflation. Wages grew at a steady but uninspiring 3% per year. International stocks delivered around 7.3%. Real estate came in around 8%. And the S&P 500? Over 10% per year. That's hard to ignore. It's no wonder that Buffett once called low-cost index funds the best investment most people can make. But it's crucial to realize when he said that, in a different interest rate environment, with different valuations, and far less capital crowding into passive vehicles, the conditions have changed. And with that, so must our thinking. Let's talk about risk-adjusted returns, because that's where the real danger lies. If you buy into the S&P 500 today expecting 10% returns, and you only get 3%, but still carry the same volatility and downside risk as before, your actual risk-reward profile just got worse, not better. And here's another factor few discuss: emotional resilience. The more concentrated the index becomes, the more volatile it may get when tech faces pressure. If one or two of those mega-cap stocks stumble, the index takes a direct hit that could rattle new investors who thought they were signing up for stability. And when fear takes over, people panic sell, often at the worst possible time. That's the kind of cascade that could unwind years of passive investing assumptions. We're entering an era where passive investing is no longer passive. It's political, it's speculative, it's crowded, and for many, it's blind. Meanwhile, companies like Vanguard and BlackRock, the giants behind most index funds, are accumulating massive influence. They vote on behalf of shareholders. They shape boardrooms. They influence economic policy. And all of this is happening while the average investor has little to no understanding of what their money is actually doing. So what's the alternative? It's not about abandoning index funds altogether. It's about context. It's about strategy. It's about realizing that now may not be the best time to go all in on passive investing with blind faith. You can still use index funds, but maybe consider diversifying beyond the S&P 500. Exploring small cap or international indexes, allocating a portion of your capital to value-based active management, holding cash not as fear, but as strategic flexibility, and above all, understanding what you own and why. Because here's the bottom line. There's no such thing as a set-it-and-forget investment anymore. The world is moving too fast. The markets are too dynamic. And blindly following old advice in a new world is a recipe for regret. Buffett has always said that investing is simple, but not easy. The simple part is knowing that discipline, patience, and rational thinking win. The hard part is applying those principles when the crowd is screaming something else. So now it's your turn. You've read the data. You've seen the trends. You've heard the warnings. Are you going to keep doing what everyone else is doing? Or will you take a step back, reassess, and invest like your future actually depends on it? Before you go, check if you're actually subscribed to this channel. A surprising number of our viewers watch regularly but never hit that button and miss out when new insights drop. Make sure you're in. Hit that bell too. The next video might just save your portfolio.